everyone. Welcome back to another session of the Wright podcast where we are talking to fund managers and trying to learn from them on how to best manage our allocation in such volatile times. As we all know, last year has been highly volatile for the equity market. We've seen a lot of ups and downs. Sectors change the direction very rapidly, and there's no predicting the direction in which the market is going. There's so many variables at play. There is high interest rates, there is high inflation, there's a geopolitical rotation, and so much more. So in this market, I want to talk to an expert and want to know from him on how we can, where we can allocate in this particular market if we want to invest into mutual funds. So our esteemed speaker in this session is Mr. Vinod Bhat, somebody I know very well from the LinkedIn Creator program. Vinod is a portfolio manager and equity strategist at Aditya Birla Fund Mutual Fund. He comes with more than 2 decades of experience in the financial markets and investment banking space. He's been with Aditya Birla since 2018. Prior to Aditya Birla, he's worked as a vice president corporate strategy and development at Aditya Birla. And previously, he was an investment banker at Credit Suisse and Ocean Park Advisors in the US. Vinod is also a CFA. He has an MBA in finance from Wharton School. He holds a master's in science from Pennsylvania University and BTech in mechanical engineering from IIT Bombay. So, I don't think you're going to get a much more experience and much more person with so much wisdom to guide us about the market. So, Vinod, welcome to the session.
Yes, thanks, Sonam. It's my pleasure to be here with you for this session, and I look forward to this.
Thank you, Vinod. So, Vinod, I have created a set of questions for you, and we'll go through these, and we'd love to hear on your insights on these.
Sure.
So the first question is, our main topic, right? Given the market volatility, what are the investment strategies and mutual funds that you would suggest that investors can use to minimize risk and maximize their return?
Yeah. No, like you said, markets have been very volatile, very unpredictable in the past few months. And just to give the viewers some context, in December when we were working on our annual outlook, the view was that Europe will go into a deep recession because of an energy crisis, and US will also see a recession because of the increase in rates. And there was a lot of uncertainty about what would happen in China due to COVID. Nobody knew about the reopening and so on, right? But just in the past 3 months, things have changed almost 180 degrees, right? So in Europe, we are not seeing an energy crisis anymore. Nobody is thinking of a recession, and the growth estimates are being upgraded. In US also, despite all the rate hikes that have been done, some of the data points are still quite strong. So now everybody's focusing on the job growth, wage growth numbers. Slowly they're coming down, and we look for the payroll numbers tomorrow. But the data points are still okay as far as the US is concerned. And everybody's trying to predict, okay, when will we see the recession? Will we be, in this coming quarter or after 6 months and so on, right? And China, of course, the lockdowns have stopped, the economy has reopened, and Chinese economy is also humming along. So that had a positive impact on those Southeast Asian emerging economies also, like Korea, Taiwan, right? So things have changed dramatically. And even India, if we see, in December, we had a view that India is in a relatively better position compared to other economies. And that still stands true. Most of the data points as far as India's economy is concerned, also quite strong, right? But the view was that, other markets might continue, like this was a view in December, that other equity markets might still continue to remain under pressure and India would continue to outperform. And what we have seen is, exactly the opposite has happened, right? So we have seen US markets, European markets, Chinese markets, everybody has given positive returns this year and India has given negative returns, right? And the volatility is also quite high. So that's just the context about the unpredictability in the markets. And also the other point is, the expected return from different asset classes. So where we stand right now, as far as equity markets are concerned, from current levels, we are not expecting a great upside. So maybe a high single digit, like a 7-8% kind of an upside, given the uncertainty. From fixed income also, we are expecting about 7.5% return. Gold, already we have seen a rally. We were expecting about a 7-8% return. So we've already seen quite a rally, right? So So going forward, the view is it's quite difficult to say which asset class might do well. It's tough to pick any one asset class, and hence the best strategy to follow to answer the question you asked, we think is a multi-asset allocation strategy, right? So there, for example, one can look at the Aditya Birla Sun Life multi-asset allocation fund, which was launched a couple of months back, or our Aditya Birla Sun Life asset allocator fund of fund. So these give exposure to 4 different asset classes: domestic equity, international equity, fixed income, and gold, and also to REITs InvITs, right? So the idea is that in this kind of an environment, given the high volatility, given the uncertainty, it's best to have some exposure to all of these asset classes. And if one asset class doesn't do well, some other asset class will do well, right? So if equity doesn't do well, maybe fixed income and gold will do well, and that will kind of balance out the return. So that is one good strategy and fund to look at. And of course, others in the hybrid category like balanced advantage fund can also be looked at.
Yeah. So that is a perfect answer, Vinod. That things are not going as we expect, right? Things keep on shifting so rapidly. But yes, even in the RBI policy that happened, I think the governor sort of recognized that the macroeconomic signals are turning positive, but we have to wait and watch.
Correct.
Right? Amazing. After this, what I want to ask you is that a lot of investors right now, are calling and asking that should they consider selecting debt funds in this current market environment where there is a lot of volatility and interest rates are high. So, what factors would you suggest that somebody who's looking to allocate to debt could consider while they're trying to do this?
Right. So debt definitely should find a place in one's overall portfolio. So, for example, in the asset allocator fund that I manage currently, we have a 55% allocation to equity, about a 13% allocation to gold, and the remaining is to debt or fixed income, right? And the reason for that is debt provides stability to the portfolio. You never know what can happen in markets on the equity side. So it's advisable to have some exposure to debt or fixed income. And there, see, our view is that, we were also surprised today. We were expecting a 25 basis point rate hike, but the RBI has kind of, maintained their policy rate. But it's still a wait and watch mode, like we said. So we believe that, we are not going to see rate cuts anytime soon. So RBI may pause at these levels, right? So we will still be in an environment of high interest rates. And hence the view currently is to remain at the short end of the curve. So basically focus on, for example, short-term funds or low duration funds or a dynamic bond fund. So these are the 3 funds one can look at. And if one can keep a slightly longer horizon, like 3+ years, if one is okay with slightly higher volatility, then they can look at, for example, a corporate bond fund also, right? So that would be the suggestion in the current environment as far as debt funds are concerned.
So why don't we look at long-term bond funds, because the rates are going to decline in the future, right?
Yeah. So right. So of course, we are all expecting that rates are expected to decline, but the question is, we don't know when, and we don't know if we are at really the last of the rate hike. So we'll have to wait and watch. For example, Fed, as far as the US Fed is concerned, just a few days back, the view was that Fed may raise by 25 basis points. Now the view is they may pause at the next meeting. But that also plays a major role in determining what the other central banks, including the RBI, do, right? So if the Fed raises rates, RBI doesn't raise rates, then it's going to put pressure on the rupee, right? So we'll have to see whether the RBI will just pause at this level, or we'll have to see at the next meeting whether they will consider a rate hike. So, and then we are not expecting a rate cut, like I said, so soon, because inflation is still on the higher side. So we expect that the central banks, including the RBI, may pause at this level, and we'll have to see whether it's later in the year or early next year is when we may start seeing some rate cuts, right? So there is still some time before we position ourselves in the longer duration funds.
Right. Great. But yeah, so the short-term bond funds again look very attractive.
Yes.
Again, the corporate bond funds have their own flavor, like you said.
Right.
But we have heard about the new taxation change that have happened and a lot of people have questions around it, right? Now that the bond funds don't enjoy the taxation benefits, is it time to shift from those bond funds? And if it is time, then where do they shift that capital to? So I would love to hear your,
Right. Yeah. So just to make sure that everyone understands the change in the taxation rule, essentially all the investments that in the debt mutual funds that have been made till 31st March 2023, they still continue to enjoy the taxation, the indexation benefit, right? So essentially, if you hold those debt funds for more than 3 years, then you get indexation benefit and the tax rate is 20%. And for any investment made from April 1st onwards, the tax rate is a marginal tax rate for the investor, right? So the investments were made before or up to March 31st, there is no issue, right? Now, currently, if somebody wants to invest in a debt fund, then the question is, should they do that or should they just keep their money in FDs or what, right? Like, so there, see, our view is, if based on the analysis we have done of all the historical data, typically debt funds have given around 0.75 to 1% higher return than bank FDs. That is one. Second is the advantage with debt funds is that you can redeem at any time, whereas if you try to break your bank FDs, you have to pay some penalty, right? And the third advantage of debt funds is whenever the RBI raises rates, for example, there is a faster transmission. So the debt funds then pay a higher interest rate, whereas it takes a longer time for the banks to increase the FD rates, right? So there are still some advantages as far as debt funds are concerned, and hence we believe that from an asset allocation point of view, it still makes sense, to have some allocation to debt funds in the portfolio.
Right.
And just one more thing, also, again, just to add, there were all these target maturity funds that many investors were investing in. Again, till 31st March, they got the benefit of the taxation. Today, they are just taxed at the marginal tax rate, but that is also something investors can consider as part of the debt allocation.
Right. But I think a lot of people are also, they're not actually looking at FD to replace the debt fund, but what they're looking at is if there is an alternative mutual fund, right? Let's say an arbitrage fund or equity savings scheme. So what
Correct.
would be, other alternatives to debt funds that people could be looking at this environment? Not just because of taxation, but generally, what are the different alternatives?
Yeah, that's a good question. Definitely, there are alternatives to debt funds if investors want to consider. On the lower risk side, one can definitely consider the arbitrage funds, right? So essentially there, the mutual fund managers, they take a long position, for example, in the cash market, and they take a offset with a short position in the futures segment, right? So the risk is much lower than if one invests in an equity mutual fund. And currently, for example, the arbitrage funds are giving anywhere between 7.25% to 7.5% return, right? So that's similar to the debt funds, right? So this is a good option to consider. Low risk, you're getting similar returns to debt funds. Second is the equity savings funds. So there, the fund manager invests in multiple asset classes. So typically, they invest between 37 to 42%. So let's say on average 40% to equity, right? And because the minimum equity exposure has to be 65% for equity taxation, they invest about 25% plus in arbitrage, and the remaining is in bonds, right? So here the advantage is that equity savings funds, you get the advantage of equity taxation, and again the risk is much lower than comparable equity funds, right? So because you have exposure to debt and you have exposure to the arbitrage also in these funds. So both these options, the arbitrage fund as well as the equity savings funds, are two good alternatives for investors to look at.
Right. Yeah. All right. So equity savings funds is something that you talked about, and I've also been getting a lot of questions about equity savings schemes, right? So if you could explain that a little bit more, right?
Sure.
What are the benefits of sort of investing in equity savings?
Right. So see, what happens is, if you look at the risk return spectrum, right? We know, see, debt funds are lower risk lower return on that spectrum, right? And equity funds are the highest risk, highest return typically, right? Expected return. And equity savings funds will fall, somewhere in between, closer to the debt fund. So like I mentioned, because the fund manager is investing in three different asset classes, if we can say, right? So typically you will have, let's say, 25 to 30% allocation to debt. So that's low risk, provides stability to the portfolio. You will have 25 to 30% allocation to arbitrage, right? So where, like I said, the fund manager takes a long position in cash equity and a short position in the future segment. So again, that is low risk, right? So almost you can say, 60 to 65% of your portfolio is low risk, right?
Yeah.
And the remaining, let's say 40% is to equity, like investing in stocks, right? So that is slightly higher risk, but that also gives you the higher return, right? Like that kind of gives the kicker, right? So overall, if you see, you can get returns which are slightly higher than if you are just invested in a debt fund without taking on, large amount of risk, right? So the risk adjusted return from a equity savings fund can be quite good. And the other advantage, of course, is that you're getting equity taxation, because the equity exposure is more than 65%. So you enjoy equity taxation on this.
Right. So, Vinod, do the hybrid funds fall into the same category as equity savings funds?
Yes. So, hybrid category covers a number of funds, right? So I'll just explain that in a little bit detail. So at one end, for example, we have what are called the conservative hybrid or the regular savings funds. So they invest 70 to 80% in debt and the remaining 20 to 30% in equity, right? So basically they are low risk with slight expectation of slightly higher return because of the equity exposure, but they have debt taxation, right? So after that, you have the equity savings fund, which we just talked about, right? So typically they will give slightly higher return than your conservative hybrid funds with a slightly higher risk because the equity exposure is higher. Then you have the balanced advantage funds. So typically in the balanced advantage funds, you will have anywhere like, between 40 to 60% net equity exposure and remaining in debt. And after that, you have the aggressive hybrid funds, which will have anywhere from 70 to 80% equity exposure. So they are on the higher risk side. And then now you have the multi-asset allocation funds also, which, like I mentioned, give you exposure not just to debt and equity, but also to commodities like gold and silver, to international equity, to REITs and InvITs. And then you also have your asset allocation fund of funds, which again give you exposure to multiple asset classes. Right. So the hybrid category covers all these funds, and equity savings fund is just one product or one solution in that category.
Okay. So in the current market scenario, along with equity saving funds, debt funds, and arbitrage funds, there might be a few hybrid funds that might also be interested.
Yes, definitely. Yes. So exactly. So given that the markets are very volatile, given markets uncertain, and the view for the next 6 to 9 months is that it's going to continue like this, right? So everybody is going to watch the inflation numbers very carefully and how the Fed reacts and what will be the terminal policy rate, right? And that is going to keep on making the markets volatile. So like I mentioned, instead of just investing in one asset class, it's better to invest in a fund which gives you exposure to multiple asset classes. So whether, like, for example, it's your equity savings fund or the balanced advantage fund or aggressive hybrid fund, which will give you exposure to debt and equity, or the multi-asset allocation fund and the asset allocator fund of fund, which will give you exposure to 4 asset classes. These are the recommended funds that investors can look at. So these can give you a better risk-adjusted return in the current environment.
Definitely. And the multi-asset allocation would also have the international and real estate exposure, commodity exposure, which.
Yes. So the advantage is, like I mentioned, these asset classes are negatively correlated. And what we mean by that is, for example, if equity is not doing well, right? So in the past 18 months, for example, Indian equity markets haven't given a high return, but then gold has done very well, right? And fixed income anyways is stable, right? And plus these funds can invest, like you mentioned, in international equity also, in REITs, InvITs, which can give some yield, right? So overall, the idea is that at the portfolio level, these funds will still give a stable risk-adjusted return. The volatility will be lower, and you can still make like a 10 to 12% return in these kinds of funds.
So I don't have the data for it, but which category of fund do you think has done the best in the recent times?
So if we look at the recent times, if you look at the past 2 years, for example, right? So we all know that equity funds haven't really given great returns. The market has been flat, right? And in that context, and debt funds, of course, like they have been in this range of like about you can say 6 to 7.5%, right? Commodities have done well because recently, like gold prices have rallied, right? So that is there. But overall, if you see the multi-asset allocation funds, the balanced advantage funds, typically, if you see the average of the peer set, they will fall in the 10 to 12% kind of a return, right? So that's very good considering other funds have not been able to give that kind of a return, right? So thing to remember is, when equity markets are going up, right? What happened in 2020, 2021? Then these hybrid funds will not be able to give the same kind of return as equity funds, right? Because we all know equity funds were giving 25% kind of return at that time, right? But when the markets are flat or when we see correction in equity markets, that's when these hybrid funds will outperform the equity funds and the debt funds, right? And as investors, that's what we want, right? Like we don't want negative returns in our portfolio. We want a stable risk adjusted return.
Right. Right, perfect. Yeah, but again, just because you said that, I had a question that people who fall into the high risk profile, right, who can take risk, they should still be allocating to equity right now, right?
Definitely.
Even though the market has not been so favorable for it, and
yes.
Like you said, only a multi-asset allocation fund has done this in the recent times. But equity should be a part of their portfolios because it will recover.
Definitely, yeah. So that's a very good point. So see, if you look at a short term, like the next 1 year, like I said, markets will be volatile. So multi-asset allocation, hybrid funds make sense, right? But if you take a step back and take like what we say medium term view, 3 to 5 years, right? Then there's no doubt that you need to invest in equity mutual funds, right? Because see, we are very positive on, especially on India as compared to other large economies. Like we believe our economy will grow at at least at a 7% real GDP growth rate, which is about a 12 to 13% nominal GDP growth rate. That means earnings growth will be also good. We expect a 14 to 15% per year kind of earnings growth for the Nifty over the next at least 3 years. And if earnings growth is good, it means equity markets will also give good returns, right? So if you can take a step back, if you take even a 3 year view, right, then of course, like one needs to invest in equity mutual funds, right? That's the best way to build wealth, right? It's just that if you're concerned about the current market volatility, then in that case, like hybrid mutual funds, multi-asset allocation funds can be looked at.
Given whatever the different types of funds that we have sort of discussed, right? Especially the ones that are suitable for the current market environment, right? Like your debt funds, arbitrage funds, equity savings, your hybrid multi-asset. What are the pros and cons of investing in these funds, and what is something that investors should be aware while considering to invest in these funds?
Right. So the first thing investors need to be aware is their own, risk profile, right? So that covers, I mean, your age, your income, and your time horizon for which you're toward till your goal, right? And that will decide your asset allocation or which funds you want to invest in. So clearly, if you are in the higher risk profile, if you have a longer term horizon, you have time to meet your goals, then equity mutual funds are the best. But there, we all know the volatility will be on the higher side, right? So you need to have at least we recommend at least a 5 to 7 year view. At a minimum, you should have at least a 3 to 5 year view, right? For you to at least see the business cycle and not exit in between, right? So that's on the equity mutual funds. And there, even in the current environment, the best funds to look at on the equity side are typically your diversified funds, right? So your flexi cap fund, multi cap fund, large and mid cap fund. Those are the funds that one can look at. And if you can keep a 3 to 5 year view, then you can also look at mid and small cap funds or some of the sectoral thematic funds.
Right.
So that's on the equity side. Now, if somebody is a moderate risk profile, right, more concerned, for example, about market volatility and so on, then definitely for them, you can consider some allocation to the hybrid funds, right? Whatever we covered in the multi-asset allocation funds, equity saving funds, and so on, right? And if somebody is in the lower risk profile, then definitely you can focus a little bit more on debt mutual funds and on these hybrid funds, right? So answer your question briefly, for somebody on the lower risk or moderate risk profile, you can look at the hybrid category. If you are in the higher risk profile, then definitely you should continue with your equity investments in equity mutual funds, and also consider some investment to hybrid funds.
Right. And again, if somebody asks me on what do they do because of the taxation change, what would be the answer to those?
Yeah, so see, the best part about hybrid mutual funds is, in most of these funds, you will get equity taxation, right? So just as an example, if I invest in a multi-asset allocation fund, I'm getting exposure to equity, to debt, to commodities, and to REITs, InvITs, everything at equity taxation, right? Whereas as an investor, if you invest separately in these asset classes, right? If you buy an equity mutual fund, if you buy a debt mutual fund, if you buy a gold ETF, then you will be facing, you will have to pay marginal tax rate on your debt mutual fund gains and your commodity ETF gains, right? Whereas if you invest in a multi-asset allocation fund or a balanced advantage fund, you will get equity taxation. So that's a big advantage of investing in these funds versus trying to do it on your own.
Right. Okay. Now again, I would, so I think we have discussed what are the different funds that would be suitable for these different categories, what would be the ideal investment horizon, and is there any reason why somebody would avoid certain funds, or any particular risk that they should be aware of while investing in these funds?
See, the risk is comes down to your time frame of investing, right? So, for example, we have seen number of investors who, after the markets rallied in 2020, 2021, they came into the markets, right? So they invested in mutual funds or even in direct stocks, and then for the past, let's say, 18 months, they have not seen good returns, right? So they are feeling disappointed and thinking now what to do, right? But that's the wrong way to look at it, right? So as long as you keep a slightly longer term horizon, like I said, at least 3 to 5 years, and markets will turn around, right? And that's what we expect. So once there is some clarity on the inflation and the rates, we expect markets will again continue their uptrend, right? So that's on the return part. And on the risk part, like I mentioned, one needs to be very clear, right? The characteristics of the fund. So debt funds typically are more stable, right? Equity funds typically are more volatile, and the hybrid funds fall somewhere in between, right? So as long as one understands the risk return profile and where these funds lie on the spectrum, then you can deal with the market volatilities and what you see on a daily basis. Then you don't need to worry about it.
Definitely. So if they have a low risk profile, if they are in a moderate to low risk profile, then definitely a hybrid fund which is more conservative might be suitable. But if they are in a high risk category, then why not invest into equity, because you get advantage of the long business cycle.
Exactly.
Might be at the bottom end of
yeah. Right. So
no, go ahead. You're saying that.
Yeah, no. So my main point, investors, is we are not running a 100-meter sprint like Usain Bolt. Okay, so we are running a long marathon. And just to add here, I've recently published a book called The Financial Independence Marathon. It's published by Penguin India, and that's where I've made this point, because in my own family, relatives, friends, I've seen that, like, especially in the 2020, 2021, where many people were investing directly in stocks or even in crypto and so on, right? And taking a lot of risk. And then now they are facing losses, right? And on the other side, some of my own family members are so risk averse, they have kept their money only in FDs for a long time, right? So again, their savings are being eaten away by inflation, right? So these extreme approaches don't work, right? And so that's what we need to understand, that it's not about making the largest amount of money in the shortest period of time, right? So that's, instead of that, the right mindset to keep is, we are running a long marathon, so we need to be patient. We need to have the knowledge of different asset classes. And then especially because typically we end up making behavioral mistakes, right? That's why it's good to have somebody you can talk to or somebody who can guide you, right? Like, for example, what Sonam is doing with Wright Research, that they are going to provide you with the guidance. They're going to help you with facing these market conditions, right? And we all see that people want to invest when markets are at a high level. So that's out of FOMO, right? And when markets correct, people want to exit out of panic, right? That's a wrong way to do it when you should be doing the opposite, right? And that's why working with an advisor or with somebody who can guide you makes a lot of sense, right? So that's the three key points I've made in my book, The Financial Independence Marathon. Have the right mindset, have the right knowledge of different asset classes, and work with an advisor who you can get some guidance from.
Right. And this is such a simple advice, but it works, miracles. If somebody follows this diligently, right, then they can make a big difference in their, wealth creation journey, I think.
Right.
Yeah. Perfect. So, so we'll wrap this up by asking you, if you have any advice and recommendations for our viewers on how, they should deal with the current market situation.
Yeah. So my advice is very simple. Like I said, just first have the right mindset, right? Don't come into markets expecting that you will make a lot of money very quickly. That will just end up taking unnecessary risk and facing losses, right? So that's the first thing. So be clear that you are here for the long term. You're running a long marathon. That's one. Second is make sure that you understand the risk return profile of different asset classes, right? So where, for example, if you're investing in stocks directly, understand the risk you're taking, right? Or if you're looking at crypto, understand it's the highest risk asset class, right? At the other end, doesn't make sense to just keep your money only in FDs because inflation will eat away your savings, right? And that's where being in between in the risk return profile makes a lot of sense. And that's where the world of mutual funds comes in. And if, for people even like me, if I'm doing a job, right, or someone who is doing a business, that is our core competency. That's our focus, right? So you should focus on your core competency and then leave the investing to the experts, right? So easiest way to do it is just start an SIP, keep investing every month in the mutual funds, and that money will get allocated to the proper asset classes, to the proper themes, and you will make your return over the long term, right? So just to give an example, about 12 years back, when my daughter was about 5 years old, I started an SIP for her higher education, right? That was 12 years back, and I have been putting some money every month in that investment, and now that quantum of money is quite good, right? And if I see the return, what we call the IRR, it's about 12.5%, 13%, which is normally what we always say, right? If you remain invested for a decade, 10, 12 years, you will make about 12 to 13% kind of a rate of return, right? So I've seen it working for myself. I have seen my classmates, a couple of them who have followed these principles building wealth, right? So it works. It's not just some theory, it does work. And that's what I would advise you to do. Make sure that you set a long-term goal and make sure you invest with discipline. And SIPs in mutual funds are the best way to do it. And make sure you work with an advisor like Sonam and Wright Research who will give you the proper guidance.
So definitely. And I'm sure that if you had, not done the SIP or not systematically invested in the bad markets, then you would not have been able to get these returns. Right? So it's very important.
Exactly. Yes.
Perfect. Amazing, Vinod. So we had an amazing discussion. I think our viewers will learn a lot from it. I definitely learned a lot. So I'm very grateful to you for joining us in this session. Our viewers, if you have any further questions that you want me to ask Vinod, right, please do write that down in the comments. I'll make sure that I'll reach out to our Birla team so that we can get Vinod to answer a few of your questions. I hope, Vinod, you had a good time, and
yes.
We'll hopefully see you again in our session.
Yeah, no, thanks for having me on this session, Sonam. Really appreciate it, and I hope this was useful for your viewers. And I do follow you on social media. I see all your posts, and I really like all the kinds of the insights you share with everybody. I think they'll be very helpful for all the individual investors.
Definitely, I follow you too, and I hope people on this channel will also go and follow you on LinkedIn, where you create a lot of wonderful content.
Great, thanks. Great.
Thank you.
Bye.